When you hear someone say, "I own shares in Apple," what does that really mean? Does it give them access to Apple's profits, a seat at the table, a voice in how the company is run? In this chapter, we explore the concept of share ownership, what rights it confers, what it means legally and financially, and how it plays out in different types of equity markets across the world. A share, often called a stock or equity, is a unit of ownership in a company. When a company issues shares, it's essentially dividing ownership of the company into small pieces and offering them to investors. If you own one share of a company that has 1 million shares outstanding, you own 0.0001% of that company. Shares are traded on stock exchanges and their prices fluctuate based on market perception, supply and demand, and company performance. But beyond price movements, being a shareholder comes with a set of legal rights and potential financial benefits. There are two main types of shares. Common shares. These are the most widely held shares. They usually come with voting rights and a claim on a portion of the company's profits through dividends if declared. However, they are last in line if a company is liquidated. Preferred shares. These typically don't offer voting rights, but have a higher claim on assets and earnings. Preferred shareholders receive dividends before common shareholders and often at a fixed rate. Owning shares gives you certain entitlements. Here are the most important ones. 1. Voting rights. Common shareholders can vote on key issues at the company's annual general meeting, AGM, such as electing board members or approving mergers. 2. Dividend rights. If a company decides to distribute a portion of its earnings, shareholders receive dividends based on the number of shares they own. 3. Capital gains. If the value of your shares increases over time and you sell them at a higher price, you make a profit, known as capital gain. 4. Access to information. Shareholders are entitled to access financial reports and disclosures so they can evaluate the company's performance. And last but not least, rights to residual assets. In the event of liquidation, shareholders may be entitled to a portion of remaining assets, although common shareholders are paid last after debts and preferred shareholders. Many companies use dual-class share structures, especially in tech. For example, Alphabet, Google's parent, has Class A shares 1 vote, Class B shares 10 votes, not publicly traded, and Class C shares no votes. This allows founders to retain control even if they don't own the majority of the economic interest. Such structures are common in the US, less so in Europe, and generally restricted in some Asian markets. They raise debates about governance and shareholder empowerment. A dividend is a payout from a company's profits to its shareholders. Not all companies pay dividends. Some reinvest profits for growth. But dividend-paying companies, often in utilities, telecom, or consumer staples, attract income-focused investors. Dividends can be paid quarterly, semi-annually, annually. They can be paid in cash, additional shares, stock dividends. For example, a shareholder owning 1,000 shares of a company that pays a $1 annual dividend would receive $1,000 per year. Price volatility. Share prices can fluctuate widely due to external and internal factors. No guaranteed income. Dividends can be cut during downturns. Dilution. Companies may issue new shares, reducing your ownership percentage. Lack of influence. Unless you own a significant stake, your ability to influence company decisions is limited. Being a shareholder fosters a sense of partnership with the company. Long-term investors often develop brand loyalty and become advocates. But this can also lead to emotional decision-making, like holding on to a poor-performing stock due to attachment. Ownership rights and protections vary by country. For example, the US and UK have strong shareholder protection frameworks. In some emerging markets, majority shareholders can dominate boards and minority rights may be less protected. European firms may emphasize stakeholder governance more than shareholder primacy. A share represents partial ownership in a company and entitles you to profits, rights, and risks. Common shares provide voting rights and potential capital gains, while preferred shares offer income stability. Ownership rights vary globally and across companies. Investing in shares is not just financial, it's a long-term commitment and a stake in a company's future. Next up, in Chapter 4, we'll explore how capital flows in the market, from initial share issuance, primary market, to daily trading, secondary market.